Hi everyone, thank you for joining us for today's video series, Pillar 2 is Coming, Book Accounting Considerations. My name is Kevin Brogan. I'm an international tax principal in Washington National Tax, and I'm excited for today's presentation, which will be made by my colleagues Tony Burzinski and Titus, both with Accounting Advisory Services. The presentation today will be with respect to Pillar 2. Pillar 2 is a very hot topic at the moment for multinationals around the globe. For those unfamiliar, Pillar 2 represents a tax system that will be adopted by a number of countries that will ensure a multinational group's operations are subject to an effective rate of tax of at least 15% or more. And the underlying calculations for this determination are made with respect to book accounting numbers. Even though Pillar 2 represents a new tax regime, because the tax calculations themselves are driven by book accounting, innumerable book accounting questions come up on a daily basis. And these become more and more pressing as Pillar 2 sets to go live in 2024. January 1st, 2024 represents the first date in which these rules will be effective in a number of countries. On today's agenda, it's two parts. The first part focuses on how does Pillar 2 impact financial statements? Well, it's a tax. So that's in one way. And then another way is what disclosures are required and when? How should companies be thinking about this process? And the second portion of today's presentation focuses on the calculation itself. As I mentioned, it's a book-based calculation where you start off with financial statements and then make a number of required adjustments under the GLOBE rules. Tony and Titus are going to work us through a number of important considerations and tricky questions that come up during this process.
Thank you, Kevin. My name is Tony Burzinski. I'm a partner in KPMG's Accounting Advisory Practice. We help with the accounting reporting for large transactions and regulatory changes, including the book accounting underpinnings for the adoption and compliance with Pillar 2. Now, in the previous videos, we covered, the expected Pillar 2 impacts on multinational companies and what the basics of compliance looked like. We also talked about the implementation progress around the world in various countries and jurisdictions. We talked about data, technology, and modeling challenges that surfaced during the implementation projects. And through those videos or other research that you may have been doing on your own, you likely have already seen that Pillar 2 adoptions include and are dependent upon many functions beyond only tax. The calculation of the effective tax rate is a combination of data from many sources beyond just tax. And on this slide, we listed several groups outside of the tax function, including legal, FP&A, IT, internal controls, and most notably for this conversation, the controllership function, who are highly likely to be involved in the adoption and compliance with Pillar 2. And for large multinationals, that controllership function likely includes several local controllers at the legal entity or jurisdictional level who are going to be critical to the Pillar 2 adoption. Now, all of that being said, we expect Pillar 2 adoptions and compliance will ordinarily be led by the tax function, but the process is very data intensive and there are numerous inputs that will often or ordinarily come from sources outside of tax. And for that reason, it's going to be important for the tax group at any companies in scope of the rule to work with those other functions, be certain that they understand the rule and the role that they play in the adoption and compliance. So in this session, we are very much focused on the book accounting considerations, or said another way, what the dependencies are on the chief accounting officer or controller's organization. And by that, I don't mean the actual accounting for the top-up taxes or deferred tax implications. Rather, we're primarily covering the book accounting numbers and concepts that go into Pillar 2, or more specifically, the GLOBE income calculation, which is not to say that the controllership function won't be involved in the accounting for the results, meaning the top-up tax or the disclosures, which are going to be beginning very soon But here we're focused on inputs to globe income calculation. So before I turn it over to Titus to talk about specific book accounting topics and inputs that are necessary for the effective tax rate calculation, or more specifically, the denominator to that calculation, which is globe income, I want to talk through what the sources of urgency are where we've got a rule that doesn't go into effect, like Kevin said, until January 1st of 2024. The rule is most notably still being written. The tax submissions are likely a couple of years away. And so the question is, why are we urgently racing towards adoption to Pillar 2 today, or at least readiness? And part of that answer goes back to what I mentioned on the previous slide, which is that there are a number of dependencies on other functions. The implementation is going to require numerous data inputs, some of which your organization may not be currently capturing, or if captured, may not be in the necessary format, or may not be reliable or well controlled because those inputs haven't been used for tax calculation or external reporting in the past. And then separately, as mentioned on this slide, there may be some pressure, or maybe some of you listening now are feeling some pressure from your audit firms and audit teams to begin disclosing the expected impacts. I know I've talked to a few multinationals who are already getting some pressure from their audit firms to be able to disclose what the likely impacts of Pillar 2 adoption is going to be for them. Another point on this slide is companies are feeling some urgency to not only estimate the incremental economic exposure, meaning the top-up tax, but also the cost of compliance on internal and external resources. And that may be an important fact for the FP&A function. And then a couple other points that I want to make, one of which relates to ongoing or ERP or system upgrades. So out in the field, we're seeing situations where our clients are in the process of implementing a new ERP or IT functionality, but because of Pillar 2, they are circling back to their functional requirements in order to be able to include Pillar 2 related requirements and functionality. And that may accelerate the need to identify data gaps or necessary functionality ahead of what they otherwise would have in order to avoid more difficult or costly system rework later on. And then finally, one last reason there's been some urgency is that for many companies, the adoption is going to be very complex and take a tremendous amount of time and resources, meaning that even given the current timelines, there may be some pressure on the company's ability to comply where there's going to be systems or process changes necessary. Now, that's not to say that every company is going to experience sort of that very heavy implementation process, but many will. And there's, depending on the company structure, how many jurisdictions they operate in, how many legal entities in a jurisdiction, and how they keep their books internally, is going to drive the level of complexity and time necessary for adoption. So with that, I want to turn it over to Titus Ball, who's going to talk about those book accounting concepts that are going into the globe income determination. So with that, Titus.
All right, thank you, Tony. As you can see, we'll spend a few minutes talking about the globe income macro adjustments, and then I'll spend a few minutes talking about some of the specific adjustments to globe income. In regards to the macro considerations related to Pillar 2, as you can see, some are related to getting the data ready for the globe calculation, some that are related to the ability to take advantage of some of the relief from a number of different calculations, and some that are related to the actual adjustments themselves. The first consideration relates to the need to utilize the ultimate parent entity's GAAP to determine what's called financial accounting income or loss by constituent entity, the starting point for globe income. Scoping entities to be included is relatively straightforward. Entities in scope are those that are consolidated on a line-by-line basis with the ultimate parent entity. For most companies, this will be relatively straightforward, while for others in certain industries, a more thorough analysis may be needed as to the scope of the rules. Once the scope is determined, the question of the proper GAAP basis will in some cases need further analysis as well. For example, some companies in preparing their US GAAP consolidation due to size and materiality may use local GAAP for particular entities as the primary basis for that process, with adjustments to US GAAP for only certain accounts. However, for Pillar 2 purposes, it may be necessary to fully convert those to US GAAP, again in the context of the level of precision needed for globe purposes. The next topic going across the page relates to consolidation. There is an election that can be made to consolidate entities in the same jurisdiction, and this is important that are part of a tax consolidation group to avoid the need to do detailed globe income loss calculations for each entity in that tax consolidation group. For many companies, current consolidation processes do not include jurisdiction consolidation points, as it is not always the case that each entity in a jurisdiction has a common parent in that jurisdiction, or statutory financial statements are not consolidated in a jurisdiction. Therefore, there may be changes to consolidation tools or processes needed, particularly as it relates to intercompany balances, to achieve jurisdictional consolidation efficiently. Next, I want to highlight one of the adjustments to arrive at globe income loss, which pertains to differences in functional currencies used to prepare the book financial statements versus that used to produce the tax return and pay taxes locally. The differences in foreign currency transaction gains and losses between those two currencies is referred to in the Pillar 2 rules as asymmetric FX gains and losses. As such, the book FX gain loss is replaced with the tax FX gain loss, again, only if they differ. This may be the case, for example, for certain foreign entities where the GAAP functional currency is the US dollar, due to it being considered a holding or shell company, and for tax purposes uses the local currency. Companies should plan to address the need to compute these differences more often to both accrue for any top-up tax as well as to ultimately prepare the related globe returns. We will spend a few minutes in a moment on the adjustments to be made to GAAP income or loss, but as you can see, there are several adjustments for which data will be needed from different systems to be able to effectively and efficiently compute those adjustments to arrive at globe income loss. I want to spend 1 minute on one of the adjustments that is made after the globe income loss is determined, is what is called the substance-based exclusion. This exclusion is initially 5% of jurisdictional payroll plus 5% of the value of tangible assets in that jurisdiction. Thus, for companies with employees and PP&E in a jurisdiction that may be otherwise considered low tax, the denominator for purposes of computing the tax rate can be reduced by these amounts. Next, one of the more challenging considerations relates to the GLOBE rules not respecting the effect of purchase accounting, or said differently, not allowing for impacts to financial accounting income loss to be affected by change in book basis as a result of the acquisition method being applied post-adoption period. Therefore, any such changes must be unwound to arrive at globe income loss. Companies should plan now on how to efficiently adjust GAAP amounts for those differences. For example, depreciation on PP&E step-ups, intangible amortization, and related deferred tax amounts. For the final box on this slide, the overarching theme from a macro perspective is that companies should begin to assess the data model that Pillar 2 requires, how that interacts with their existing data models within their ERPs, consolidation systems, and other data tools, and address any related gaps that arise, along with reviewing controls and procedures in place to ensure completeness and accuracy of that data. One of the areas that may need to be thought through in addition to the above are how disciplined organizations are with respect to intercompany transactions, and whether those are recorded or whether some are ignored due to the ultimate elimination in consolidation. Since the GLOBE rules deal with standalone entity financial information, it is critical to ensure intercompany transactions are fully reflected on an arm's length basis in each constituent entity's accounting results. Determining globe income necessitates the computation of a series of adjustments that are listed on the slide. Some of them are relatively straightforward, like policy disallowed expenses, such as penalties, while others are more complex. I mentioned asymmetric FX gains and losses earlier as an example of an adjustment that may require significant system analysis depending on the size and volume of those types of transactions. I also wanted to highlight a few others that are more straightforward and generally more common. First are excluded dividends. These are any dividends that are from other than what's called short-term portfolio shareholdings and are excluded from globe income. Portfolio shareholdings are those that are less than 10% owned, and short-term meaning held for less than 1 year at the date of distribution. This rule applies to controlled entities, so intercompany dividends, as well as equity method investments. Second, excluded equity method gains and losses. Globe income loss should be adjusted to exclude losses and gains arising from 3 basic categories related to equity method investments. A, changes in fair value of an equity method investment if the fair value option is used. B, equity method income or loss, and C, gains or losses from disposition. Unless, and this is important for A and C, it is what is termed a portfolio shareholding, which is generally owning less than 10%. For those entities, such gains and losses are included. Next, qualified refundable tax credits. Where a tax credit is considered to be refundable, and is recorded as a reduction in income tax expense, such credit must be added back as an addition to covered taxes. Any refundable tax credit included in pre-tax income remains in globe income and is not adjusted. Next, I wanted to highlight accrued pension expense. So like most tax regimes, entities that record net periodic pension expense for defined benefit plans under GAAP will exclude those amounts from globe income and include a deduction when cash is contributed. And then finally, I wanted to highlight stock-based compensation. Another election that companies can make is utilize the tax-deductible amount, generally what the employee's taxable income is, instead of the GAAP stock-based compensation cost. You will also see there are other specific rules related to permanent establishments and flow-through entities. The headline here is that if there are permanent establishments that exist, they will need their own globe income analysis apart from the main entity. This may necessitate a mini carve-out of the GAAP amounts from the main entity to be able to compute the globe income amounts for permanent establishments. Finally, the globe rules have specific guidance related to when entities join and leave a group, when there is an internal reorganizations that are performed, and rules related to flow-through entities, hybrids, and joint ventures. The headline here is for tax and accounting to be clear as to the data needs from a GAAP perspective for these situations, as they must be considered when designing the data model and performing any data gap analysis. For example, the definition of a joint venture under the globe rules is different from the GAAP definition of a joint venture. Making sure that both teams understand those differences will assist in the effort in modeling as well as designing any related compliance function. Thank you again for joining us for this video. If you have any questions on book accounting impacts, please reach out to Tony or I in Accounting Advisory Services.